This is the Market Doll Queen, and today we're going to learn how to trade using the MACD indicator. MACD stands for the Moving Average Convergence Divergence, and now you know why they shortened it to the MACD. But simply put, the MACD is a trend-following momentum indicator that shows the relationship between two moving averages of a security's price. The MACD is calculated by subtracting the 26-period EMA from the 12-period EMA. And the result of that calculation is the MACD line, which is my blue line right here. And then the 9-day EMA is called the signal line, and that's my white line right there, okay? The blue one is my MACD line, and the white one is my signal line. The signal line is put on top of the MACD to function as a trigger to buy and sell. So basically, there are three different ways to use the MACD to your advantage in conjunction with your other indicators and the chart to better understand where to enter and exit a trade, and to follow trend and to see it even before the chart shows it to you. And those three are the zero line, the signal line, and divergence. And we'll start with the signal line first, the zero line. So first, the zero line is right there. That's the straight line that goes straight across the middle. And basically, the zero line means when it moves across the zero line, it represents when the 12-day is crossing the 26-day EMA. When it crosses from below, it means a new uptrend may be coming. So right there. If it crosses from below, it means a new uptrend may be coming. When it crosses from above, it means a new downtrend is coming. The strategy is to buy when the MACD crosses above the zero line and sell when it crosses below. So buy when it crosses above and sell when it crosses below. But this basic strategy doesn't offer as many opportunities for trading, so most traders use the second way, the signal line crossover. So right here, my signal line is the white one. So the signal line crossover, they provide better timing for entries and exits than the zero line crossover. I actually prefer the signal line crossover instead of the zero line crossover, as do most traders. And simply put, a buy signal is when the MACD crosses above the signal line, and a sell signal is when the MACD crosses below the signal line. So I will show you an example right here. So right here, the MACD crosses above, and it's a buy signal. As you can see right up here, it's right before these candlesticks are starting to climb. So this is a buy signal. You would have bought right here. And then this, actually right here, is a sell signal when the signal line crosses over the MACD. So buy here, sell here. Buy here. And probably you could sell here, sell here. I actually prefer the signal line. As you can see, it gives you better entries and exits, and it means there's more chances for profits for you. And that's why I prefer it. There's plenty more opportunities. As you can see, it crosses the zero line only occasionally, but it crosses the signal line many times. So these can coincide with the actual chart lines. As you can see here, the candlesticks. So if this is a cross line right here to buy, this was a great place to buy, and then it went up and up and up, and then it gave you this signal right here to sell, and that is right before it dropped. And that's why this system is preferred. Now, the third is divergence, both bearish and bullish. And it actually defies everything you think you know about the MACD. So right here, I'm looking at GM because it gave me both sets of a bullish and a bearish divergence. First off, this is the bullish divergence. And the bullish divergence is when the price is making new lows, as you can see right here, but the MACD isn't. See, the MACD is going up, but the price is going down. That is a bullish divergence. And that means that selling pressure has slowed down and a reversal may be coming, which you can see right here. You thought it was going down, but the reversal was coming. The MACD gave you the signal right there, and it did. Now, the opposite of that is the bearish divergence, and that's when the price is making new highs, but the MACD isn't. So right here is the bearish divergence. You can see that the price is making new high, but the MACD isn't. The MACD is going down, down, down. This means that selling pressure has slowed down and a reversal could be on the way. And that was at close on Friday, October 25th. That's why I used this chart. It gave me both opportunities to show you a bullish divergence and a bearish divergence. That just helps you understand the actual trend. And until divergence is confirmed by an actual turnaround in the price, don't do any trades based solely on the divergence factor. Please use other factors to help you decide where to enter or exit this trade. Now that we've covered these basic elements of the MACD, let's go ahead and go to XNet. XNet on October 25th, which was a Friday, I alerted first thing in the morning as a scalp alert, and it gives you a couple of opportunities where I can show you the buy and sell signals, and I'll show you why I chose where I did and why I didn't. So first off, the first buy signal was right here. Let me see if I can blow it up some more. A little bit more right there. The first buy signal was right in there. But I didn't alert there because I didn't like the volume. There's actually no volume right there. It was too slow moving. You could have got in there and you would have been fine, obviously, as you can see from the chart, but we didn't know that first thing of the morning. But it did give me the signals. Where I did alert it was right in here. Now you can see that the MACD and the signal line are starting to get further apart. That's giving me a good signal that momentum and volume is starting to pick up. And I did alert right in here. I alerted at 280 first thing in the morning. So it was right in this candle right there. That's where I alerted the scalp alert. And as you can see, you can continue on holding it. Now the first sell signal was right here. And it coincides with the chart right there. It started to turn down. You could have sold right here and been in beautiful gains and been safe in and out of that trade. You see that? This shows you the downtrend right there. Now we have another possible buy signal. You could have bought anywhere in here, but this was kind of flat. It's kind of going sideways. Didn't like it so much. But here's another buy signal. Right there is the buy signal. Look at the green candle right there. That's where the buy signal is. That's where the MACD crosses over. And that would have been another great place to buy, enter into a trade, and then you would have carried that trade up until your sell signal, which is right there. And that's where the downtrend came. As you can see, the MACD gave you the downtrend. Now let me also describe these green bars. They are exactly what you think. They are momentum. They are helping you decide the difference between the signals here. If we've got bigger bars, then we've got more momentum, more volume. If we get down to the 0 line and it turns down into the red, then we're down into a downtrend. As the bars get smaller, we're starting to squeeze on up. You can see this. As you can see, the MACD gives you many opportunities, whereas if you use the 0 line, you would have entered and stayed in the trade completely for the whole day. And you would not have been wrong either, as you can see. All the way to the end of the day, you would have been in the green. So the 0 line would have kept you in the trade. The signal line crossovers have given you many opportunities to trade. And now that I've explained this more to you, I hope you understand it and apply it to other tickers and see how it coincides. See how they cross over and see how it coincides with your candlestick charting. And you'll see that this helps you gauge where to enter and exit your trades to lock in those gains. And isn't that what we always want to do?